Good day. My name is Zvino Mapetere, and I would like to do a recording on the VAT, how VAT arises on imported goods. Now, our learning outcomes are building on what we have already done on VAT from section 6.1a, which is about the arising of output tax on the supply of goods or services by a registered operator in furtherance of trade. So we'll largely look at the importation of goods and the VAT that arises from that, which is import VAT. We would like to look at the classification whenever we import goods for VAT purposes. What are the classification implications? The value of supply, the time of supply, and any pitfalls that learners may potentially fall into for their exam purposes. Let us dive straight into imported goods and import VAT. Naturally, we now need to understand what to import means for VAT purposes. Goods, because we are dealing with 6.1b, which is about imported goods, as opposed to services or any other. But here we're dealing with goods. So it is necessary for you as a learner to revisit what we have already covered in terms of the definition of goods for VAT purposes, which is in section 2, dealing with interpretation of terms. So imported VAT, section 6.1b says there will be VAT, which is import VAT, on the importation of any goods in Zimbabwe by any person on or after the fixed date. So remember the fixed date issue, 2004, when VAT was put in effect in Zimbabwe. So that's not the key issue, especially for exams. It's about importation, your understanding of importation. And I've just created my understanding of importation, and you can borrow it as well, just to see what could be the key issues. First is about who is supplying, and secondly, who is receiving these supplies, right? And the different jurisdictions which either these people are resident in or are operating from. So with an importation, my understanding is that you've got to have a supplier who is a non-resident or who is operating outside Zimbabwe. And then the recipient must be a resident. But further to that, that resident must then utilize or consume the goods in Zimbabwe. So that's very important, and we'll pick it up when we do our value of supply, our time of supply rather. Then it is also important to note that section 36 of the Customs Act is a relevant section, because a lot of things will then apply mutatis mutandis, which means whatever has been determined under the Customs Act can then be applied to the VAT Act in terms of, has an importation happened? When has the importation happened? What are the values in that importation? So what would have been covered or dealt with by ZIMRA applying the Customs Act, they will then take it and use it for VAT purposes. So in terms of classification, your classification does not change. Standard rated goods, zero rated goods, and exempt goods do not change. And to guide us, we have a section 78, which talks about regulations, and there are regulations. And these are read in conjunction with the Finance Act. So they will give us a list and guide you as a learner to say this is zero rated, standard rated, or exempt. So when you import, you still have to classify those goods and see if they are standard rated, exempt, or zero rated. Right, let's get to the time of supply. When for VAT purposes are you deemed to have imported? That's going to be very important. And we have section 12 to guide us on that. And the important thing there is that goods are deemed to have been imported when they enter the country for home consumption. Remember, my understanding of an import as foreign supplier, in other words, they are not resident in Zimbabwe or are operating from outside Zimbabwe. So that's a foreign supply. And recipient is what? Resident here. But it's not enough to just say they are resident. You have to then consume in the home country. So let's apply that. Mrs. Moyo stays in Mberengwa. Mrs. Moyo then buys cooking oil from Pick and Pay Pretoria. Pick and Pay Pretoria have this voucher system where you buy points, they supply, and then there's a courier who then transports from Pretoria via Beitbridge border post, and there are also courier services from the border post to Mrs. Moyo in Berengwa. So let's look at that transaction and say, are they imported goods for VAT purposes from what we've learned? What did we say an import was? We were looking at foreign supplier, and foreign supplier, we're looking at someone who is a foreign resident. In this case, Pick and Pay Pretoria is a foreign resident, or someone who operates from outside the country, and that also applies to Pick and Pay Pretoria. So the one leg has been satisfied. And then we also said it's an import if the recipient is a resident, a Zimbabwean resident, and Mrs. Moyo is a Zimbabwean resident, lives in Berengwa. But we said further to that, the goods that have been supplied must be used for home consumption. And in this case, we're saying the cooking oil will be used in Zimbabwe. So yes, there is imported goods. And then the question is, so when were these goods supplied, so that we know when VAT can also apply? The moment the goods entered the country for home consumption. So there's two parts of that statement: entrance into the country and for home consumption. So that's very important. So if we go here, we'll have to say goods should have entered the country and it must be for home consumption. So that's going to be a crucial element of our definition. So yeah, could there be a situation where goods enter but are not then viewed as for home consumption? Yes. So Mrs. Moyo also has a batch of cooking oil that she definitely bought from Pick and Pay Pretoria, but is supplying to her clients in Zambia. So whilst the goods will enter into Zimbabwe in transit to Zambia, they've entered but not for home consumption. Therefore, no supply has happened in terms of imported goods. So let us look at value of supply. In terms of value of supply, the value of supply shall be deemed. And why are we saying deemed? Because remember, the actual purchase price that was supplied by Pick and Pay Pretoria is an X amount. But from there on, certain costs accumulated which are part of the computation of VAT. So courier services from Pretoria to the border post or to the port of entry for customs purposes are loaded into the value of the goods for duty purposes. And once we have the value for duty purposes, the state will charge duty. So that value for duty purposes plus the duty, it becomes the value of supply, excluding surtax. And then 15% VAT is then chargeable on that. So value of supply is equal to the value for duty purposes plus duty. So the VAT becomes value of supply by 15%. And we're saying the value for duty purposes will include the cost and the insurance, if any, the freight, and any other associated charges that were part of bringing the goods to the port of entry. Let us look at the common student pitfalls. Students sometimes confuse goods and services. This is very important for your examinations because goods and services are different in terms of a number of items that you need to treat. For example, they can have different classification, medical goods and medical services. Medical services are exempt, while medical goods are not necessarily exempt. So that's an important element. But you also need to know whether they are services or goods because of other aspects in terms of how output tax arises and whether or not input tax becomes claimable. So it's always very important for you to understand that goods and services are different, and you always go back to the interpretation of goods and services in section 2. Then there's the element of conflating section 6.1a principles to section 6.1b principles. What are these sections? Quickly, a recap. 6.1b is what we're dealing with today. Import VAT that arises from the importation of goods. 6.1a is our earlier topic where we dealt with output VAT that arises out of the supply by a registered operator of goods and services in furtherance of trade. Like largely, that's the gist, that's the core of it. In this case, output tax is still arising, but it's arising completely differently from 6.1a. So candidates in their examination, sometimes when they are trying to make a determination or when they're trying to support why import VAT must be charged, they may then mix the whole registration and furtherance trade of trade purpose principles. Let us have a quick look at an example that brings out the difference between these two. OK Zimbabwe, which is a large retailer registered operator, imports a car from Japan. Takura Moyo, a non-registered operator, imports a similar car, same price, from Japan. Now, what is the difference between these two taxpayers? Two key differences that will come off, that jump off the page. The one operator is registered, which is OK Zimbabwe, and Takura is not. Second difference is OK Zimbabwe wants to use the imported car in furtherance of trade. Takura does not. When the goods, the cars are goods, enter the country, they will be entering for home consumption. So the moment they get to the port of entry and enter the country, they've entered the country for home consumption. So that's the time of supply for output VAT, which is import tax. I'm saying that VAT has arisen regardless of the registration status and regardless of the fact that the one is going to be using it in furtherance of trade and the one will not. So that's those are fundamental differences. And I'm saying candidates sometimes in the examination, in discussing the import VAT, VAT arising from import tax, they conflate the two sections and argue incorrectly as a result. And then another challenge is the concept of import tax and input tax. So import tax is akin to output VAT. It adds to your output VAT. You are not claiming it as yet. However, when you import, you can have both the import tax and, depending on what you have imported and the section 16 rules of the VAT Act, you can also have input tax over and above the output import tax. So let's go back to Takura Moyo and OK Zimbabwe. So once they've imported the car, total value of supply, ultimately say it is 100,000, VAT 15%, so they then pay the 15,000 VAT. That is import VAT, which is an output tax or adds to your output tax. Once that has been done, both taxpayers now need to turn around and say, can I claim input tax on this 15,000? So now input tax rules begin to apply. And quickly, Takura definitely can't claim input tax because they are not using this vehicle to make taxable supplies. Whereas OK Zimbabwe is eligible. It's now just a matter of other things like documentation, and so on. Candidates struggle there. They leave marks on the table in that, in a discussion type question where you have been asked to discuss the VAT implications of an imported vehicle or goods, they may discuss the output tax or the import section, but may forget to discuss that this is also claimable for input tax, which can give them further marks. Let us look at the concept of time of supply. And candidates sometimes struggle, do some memory dumping by going to other time of supply rules that they've seen earlier of this, that, and the other. Forgetting that the core principle here is home consumption, entry at the port of entry. And sometimes candidates, as you are explaining and teaching, you may talk about borders and so on. And in their solutions also do that and say when the goods enter at the border. So that is not necessarily a tax principle. Maybe someone was explaining and saying, so the goods will enter at the border and as part of an explanation. But that does, the candidates tend to memorize verbatim what someone was saying, what a tutor was saying, and then they convert it into a tax principle. Yet it is not a tax principle to say when goods enter at the border. It's about entry into a country at port of entry and home consumption. That then determines the timing. Remember, some goods cross the border using an aeroplane. So how are you going to deal with that? The port of entry becomes maybe Harare International Airport. But they crossed the entire border when the aeroplane crossed the border much earlier before it even got to Harare. Yeah, candidates also struggle with computational aspects such as value for duty purposes, and particularly in your examinations, the one that normally sticks out is the one for freight. Remember, there's freight before the goods get to port of entry, and there is also post port of entry freight. And you need to say which freight charge will be included in my VAT charge. And definitely post port of entry freight is no longer part of the VAT computation because importation has already happened, so import VAT has already been dealt with. And also to say pre-importation freight is going to increase the value of supply and therefore will be adding to the value of your output tax, which you may also then go ahead to claim input tax. But post importation, you are not generating output tax, but the implication can only possibly be input tax. Now, depending on who did, how were the freight, the context of the freight services post importation, were they supplied by a registered operator? Did the operator charge VAT? Are you also using those supplies which were being transported to make taxable supplies? Do you have the appropriate documentation? So freight candidates sometimes struggle with how freight is treated. Pre-importation, post-importation freight are different in terms of their VAT implications. Thank you.